Hello, everyone. Hello, everyone. Welcome Monday morning, March 5th, 2025. It is so good to see you all this beautiful Monday morning right here in Austin, Texas. It is so good to see you all. I hope you had an absolutely amazing, excellent weekend. And you all, we've got a lot to go over this morning. Monday morning touch point. That is when we update the infamous and highly reliable new listing to pending ratio. Really excited to go over some additional information that I've been compiling and putting together over the weekend. And we also have the inventory that we're going to go over. We're going to talk about the bond market. What is going on with the 10-year Treasury? And we had a very interesting event happen over the past few days. That is where the 10-year and the 3-month yield curve inverted. Last time the inversion happened, which is a very agreed upon and clear recessionary indicator, we ended up not having a recession. Will that be the case this time? So if you follow a lot of the economic YouTube channels and economic news channels, CNBC, Fox Business, whatever the case might be, they've been talking about the yield curve inversion. So there's a lot of data to go over today, a lot of information for us to tackle. But we are going to start with the new listing to pending ratio. Let's go ahead and just bring this up. And first thing I'm going to do is share my screen with you so that you can see. Let's go ahead and get some thumbs up. If you could please give me some thumbs up so I can make sure that you can actually see my screen and you can hear me okay. Let's go ahead and just do a little bit of a thumbs up. Okay, good stuff. Thank you so very much, Harold. I super appreciate it. Melanie Price Renee, thank you so very much. And here we have the new listing to pending ratio. As you know, a very reliable leading market indicator telling us exactly what's going on each and every week in our current market. We're also going to do a really thorough analysis of February of this year, 2025, to see what happened with sold properties, what happened with the overall market, especially looking at inventory, pendings, and solds. Let me go ahead and just get Matrix here up and running, because the first thing that I want to do is I want to update the number of open house offerings over the past 7 days within our MLS. So that's going to be from the 24th all the way to the 3rd, which is today. Number of open houses, we are looking at a total of 2,977 open houses. That's going to be the largest number going all the way back to September 9th, 2024. So we see more and more open house offerings that are taking place. And I'm seeing open house signs all over the place. I don't know if that's the same case with you, but I'm just noticing, especially within the Cedar Park, Leander area, a ton of open houses. Now that we've updated the open house, let me go ahead and just go a little bit backwards in time. As you know, all of the information locks in at 11:59, except for pendings. Pendings, we will update pendings for the next few weeks. So we always focus within the 6-county area: Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett counties. And we're going to go from the 17th all the way to the 24th. Oh, can y'all hear like a little static background? I don't know what in the world is going on here. Give me 1 second. I hear a static background on my end. Oh, this is like, can y'all hear this, or is it just me? Okay, is this better, you all? Okay, good. This is way better. Oh, I could hear some static background on my end, but now I cannot hear it anymore. Now it is absolutely perfect. So we're looking at pendings, and that's going to take us to 440, 6-county area: Travis, Williamson, Bastrop, Hayes, Caldwell, Burnett. That's going to bring the new listing to pending ratio for 2 weeks ago at a 0.76. That does put us within that, right around that tangible increase in inventory. That's what's going to be the tangible increase in inventory, right at that 0.76 ratio. So, really interesting just to see that ratio going on. Okay, we lost sound. Let me go ahead and just get the sound back up and running. Let's see what's going on here. Okay, it's back. Okay, good stuff. It is back. I am noticing that is switched over to a different soundboard, so the sound might be a little bit off. Looks like it switched over to a completely different soundboard. Well, it is Monday morning, you all, and we are having some Zoom technical issues here, but you know what? It is what it is. That is a-okay. If you can hear me okay, then that is absolutely great. I've got actually three mics. I've got the primary mic, the one that I am talking and it's recording, and then I've got a secondary mic that is attached to the actual camera as a failback just in case something happens with the actual primary one. But it does look like the soundboard right here disconnected from Zoom. But as long as you can hear me, that's okay. Want to give a thumbs up, make sure that y'all can hear me. Okay, good stuff. Now, also keep in mind that the recording will have the nice deep voice coming from this main mic because I record this in a separate channel. But as long as you can hear me okay, then we're just going to roll with it. So let's go ahead and get all of this updated. That's going to take us to 440.76 ratio. Let's go from the 10th to the 17th. That's going to take us to 435. Let's go from the 3rd all the way through the 10th. That's going to be 492. Let's keep on going. We're going to go from the 27th to the 3rd. That's going to be 521. We're going to go from the 20th to the 27th. That's going to be, 457. Why are we updating everything backwards? It's because agents are really bad when it comes to updating pendings. That's why this is going to be 404. Then from the 6th to the 13th, this is going to be 364. Great. Now everything is updated. We can now start updating the past week, and that's going to be from the 24th all the way through the 3rd. And we're going to take a look at new listings. Whoa. Okay, you all, this is a big deal. 1,128 new listings from February 24th all the way through March 3rd. And now keep in mind that because it is March 3rd, we're still going to have some new listings come on the market between now and the end of the day. So this number is going to cross the 1,200 new listing mark. We're at 1,128 right now. It is going to cross the 1,200 new listing mark. I am going to focus a lot over the second part of the meeting on new inventory hitting the Austin area, along with pendings. What is going on with pendings? A lot going on with pendings right now that we really have to understand, know what's going on with not only our market, but the entire national market. I did post something over the Facebook group, the Team Price Facebook group. If you're not a member of the Team Price Facebook group, please reach out to me. I'll send you the link and we will make sure that you are in that group. Price decreases, we're at 127 price decreases. That's going to be the lowest one so far, going all the way back to October 21st. Price decreases, we're at 1135. That's going to give us a 90% ratio. Let's take a look at back on the market. We are at 189 back on the market. That's going to give us 17%. The lower the back on the market, pop quiz. Here's a pop quiz. When the back on the market plummets, does that show a hot market or a slower market? When the lower the back on the market, is it the worse the market, the slower the market, the colder the market, or the hotter the market? What do y'all think? What do y'all think? Okay, let's take a look. Yeah, it's exactly it. It means the slower the market. Counterintuitive, but when the back on the market plummets, what does that mean? That means that the sellers are willing to negotiate. That means that the buyers looked at 1,000 homes. They like what they put an offer on, and the sellers are like, okay, whatever. Oh, you want $5,000 after the inspection? Fine. It took me 75 days to get the home under contract. I'll give you $7,500. So we do notice a trend where when the back of the market starts retreating, that does indicate a slower market. Bertina said they don't want the house to go back on the market. You're absolutely right. That is also an indication of the market. Active under contract, we are looking at 483. Now, this is where you get to guess. You get to guess how many properties are currently on the market or pending. How many pending properties? I'm not going to pull up this figure quite yet. How many pending properties? Please, you go ahead and let me know how many pending properties. Let's get 5 guesses. Melanie is going to start us at 189. Okay, good stuff. Melanie's going to start us at 189 pending properties, 189. And we've got quite a few right here. Let me go ahead and just start reading everything. We've got 189, Melanie, Bertina at 202. We've got Sonia at 237, Rowan at 220, Mr. Kevin Walker at 212, and we've got Anai at exactly 200. Let me go ahead and just pull this up. Just give me 1 second. On pendings, we are looking at, this is encouraging, 249. 249. Not bad. Not bad. I'll take this. 249 pending transactions. Harold came in at 250. Harold, you win. That does put us at the 0.56 ratio. The reason why is because we have an explosion of new listings that are hitting the market. We are seeing a substantial increase in the number of new listings entering the market, you all. It's a lot of new listings are entering the market, especially for the last week of February, first week of March. This is a huge number of new listings entering the market. So this ratio is on the lower end, on the slower. What does that mean for us? We're not going to hit 0.76 like we did last week. We are going to be right around the 0.70 to 0.72 ratio when it's all said and done. That does put us within what? That tangible increase in inventory. More and more listings. Sonia said, I'm seeing a lot more buyers, so many more listings. A lot of listings coming on the market. You're absolutely right. So let me do this. Let me go ahead and just move this out of the way. Let me print this as a PDF so that I can review this as a PDF, because I do want to focus on the monthly data, which for February, we're not going to do March monthly because it's really early in the month of March. But the February data, when you look at listings, when you look at pendings, when you look at solds, it's very eye-opening and certainly something that we have to be very, very aware of what's going on with the market so that we can position ourselves accordingly. We can position our clients accordingly, of course, our listings. So let's take a look at it. We did the weekly. Last week, which means last week's update, 2 weeks ago, we did have a 5.7% increase on the number of new listings entering the market. So far today, we are down 12% when you look at it year over year. I believe that we're going to make up this gap of 154 listings between now and 11:59 p.m. tonight. We are going to be positive. We are down on price increases 120. We are up 24 on price drops, 33 less back on the market. You can see the retreat of the back on the market going all the way back to the second week of January. The part that we have to be aware of is take a look at this. So we've got the active under contract and the pending. We have now been negative year over year on pending. A lot of them double-digit negative on pending going all the way back to the beginning of the year. So far this year, we are lagging last year when you look at pending properties. Let's take a look at the monthly data, and I just want this just let this sink in. Let this sink in for a little bit. February, we are at a 0.69 ratio for the month of February. Slightly better than January at a 0.68. but we are teetering between that substantial increase in inventory and that tangible increase in inventory. Month over month, of course, listings went up. Year over year, we were actually down 83. But when you look at this is the chart that I want us to focus on right here. This one, number of new listings. We had 3,996 new listings come on the market February. And even though we are down year over year, that's because February of 2024, we had an astronomical number of new listings entering the market, 4,079, which was way more than the year before. It was a 27% increase from 2023. Or that's month over month. Year over year, a 44% increase. So February 2024, we had a 44.2% increase year over year on the number of new listings entering the market. And then we went down, we retreated by only 2%. But then January, we were up 20%, 19.9 to be exact. Melanie, you've got a question, go for it. No, I can definitely change that. That's really easy for me to change. It takes me 2 seconds to change. Well, as a matter of fact, I think on this chart, I would rather do like a red-green as opposed to a blue-red. I think the red-green on this one would be more appropriate than a blue-red. What do you think? Yeah, so can you send me a message? Send me a note on that. Send me either a text message or an email. And by the time 5 minutes after this meeting is over, it'll be corrected and the published information will be. I could even do it right now, but I want to make the best use of our time. So send me a message, send me an email, and it will get done within 5 minutes after this meeting's over. I completely agree with you. As a matter of fact, I'm going to do that on this one, on this one. So all the ones that have a year over year percentage change, I'm going to go ahead and change this from red blue to a red green, high number being green, lower number being red. So I'm going to go ahead and change that. Really good feedback, Melanie. Y'all, I love feedback. I absolutely crave feedback. So thank you. Thank you for that. So you can see that the year over year, we are down 2% from a 44.2% increase. So inventory is absolutely going up. And take a look at the cumulative inventory. This is going to be January plus February. We are 27.8% above average. We are 7.6% above 2024. When you look at January plus February, we just reached a record high new listings going back 25 years. Record high number of new listings entering the market. So really interesting to see it that way. Let's keep on looking at some additional graphs. Let me keep on going right here. We've got new listings per 100,000 people. Let me keep on going. Okay, back on the market. Now let's focus on pending properties. So we've got way more new listings. And let me bring up this one. I'm gonna go back and forth between two charts. One of them is going to be the new listings. This one, cumulative listings, up 7.6%. You see that number? Memorize that number, 7.6%. As a matter of fact, someone over chat, write down 7.6% so that we can remember this. 7.6% year over year. Okay, good. Thank you, Sonia. Now we're going to look at pendings. Let's take a look at pendings. It's going to be this one right here. Pending, down 14.7%. So we've got cumulative new listings up 7.6%, and we've got pending listings down 14.7%. What happens with that? Active listings go up. That's what happens. Active listings keep on reaching record highs because properties are not being absorbed by the market. And of course, that is reflected by that new listing to pending ratio. So there's your snapshot for the morning. Inventory is going up. Not only is it going up, but it's now going up at an accelerated rate when you look at January and February 2025. Last year, when we had a really good October, November going into December, what did we say? We're like, hey, a lot of properties were withdrawn, a lot of properties expired. My prediction is that we're going to see an increase on new listings come 2025. And I said, we will know by February whether or not that's going to be the case. And now we can say for a high degree of certainty, that is absolutely the case. Inventory is going up at a fairly consistent and substantial way. So keep that in mind as you are working with clients. Let's look at a few more things. Okay, active minus pending. We're at 7,687 active minus pending. And you can see total withdrawns or expired. This is going to be the month of February, and that is going to be the highest number of withdrawn and expired for February going all the way back. So we've got 820 withdrawn plus expired. On January 11/26, but 820 withdrawn expired, highest going all the way back to 2011. Total sold. This is another one that's a little bit of a shocker. 2,059 sold. 2,059. Last February, 2,241 sold. So when we look at the cumulative sold, all of January, all of February, we are lagging 2024 by only 1.1%. But keep in mind, the properties that sold January went under contract when? November, December. How was November, December? Very much on the positive. So what do I expect going into March, into April? A further decrease on the number of sold properties because we're not going under contract on enough properties to keep up with last year. So as of now, we are going to be lagging last year when you look at the number of sold properties because we are down 14.7% on the number of pending properties. And you and I both know if something doesn't go pending, guess what? It doesn't sell. So we are going to be lagging last year on the number of sold properties. Let's keep on looking at a few more things. So far this year, the new listing to pending ratio is at a 0.69. That's going to be the new listing to pending ratio so far this year. Very much lagging last year. So far, we're only into March, and this is data for only January and February. The new listing to pending ratio tends to go up and down throughout the year. So we're just going to have to, of course, keep a really close eye at this. But we are starting this year lagging compared to last year. The big question is, will this keep on going for the rest of the year? Or are all of the reasons why we're lagging accurate? Oh, it's the weather, it's this, it's the election, it's too hot, it's too cold, it's too perfect. I would say that I'd say this year is going to be absolutely lagging last year. I'm absolutely convinced of that. So that's my personal prediction, is that this year is going to lag last year because there are other data points that I want to look at to confirm that. Well, let's take a look at a few more things. I posted this on our internal Facebook group, and I'm undecided whether or not I'm going to put this within Insight and Statistics. I'm undecided. I've got the data. I've got everything ready to go. It's just a matter of whether or not I want to create the page, credit, NAR. We'll see. As of now, I don't plan on putting it. I just plan on making it internal, but we'll see. This one right here is the National Association of Realtors Pending Home Sales Index. Now, I want to read something here that was mentioned. Let me go ahead and just read this. This is super accurate. The Pending Home Sales Index, a leading indicator. Well, you all know me, especially the old timers. What do I like? Leading or lagging indicators? I'm a big fan of leading indicators. I don't care what traffic was like 10 miles before. I care what traffic is like in front of me. I'm a leading indicator. I'm obsessed with leading indicators. What is happening today? What's happening now? Lagging indicator simply tells me what happened 3 months ago. For me, I always use the traffic analogy. I could be going 75 miles an hour and be like, great, this is going to be awesome. It's going to take me only 3 hours to get to Dallas. That's the lagging indicator, without knowing that there's a crash in Waco and it's going to take me 5 hours. That's the leading indicator. So I'm really more concerned with a leading indicator. And the pending home sales index is a leading indicator of housing activity, measures housing contract activity, and is based on signed real estate contracts for existing single family homes, condos, and co-ops. Because a home goes under contract a month or two before it is sold, the pending home sales index generally leads existing home sales by a month or two. That's the leading versus lagging indicator. I'm going to read something by our dear chief economist. According to NAR chief economist Lawrence Yun, forgive me, Lawrence, if I pronounced it incorrectly. Let me make this bigger. And I'm going to highlight this. It is unclear if the coldest January in 25 years contributed to fewer buyers in the market. And if so, expect greater sales activity in upcoming months. However, it is evident that elevated home prices and higher mortgage rates restrained affordability. What is he saying here? Well, let's take a look at the data. He's like, well, we're not sure if the reason why the pending index was at the lowest was because we also had the coldest January. So when you read this at first, you're thinking, well, the coldest January contributed to fewer buyers. You might think, well, the coldest January in 25 years, you might think that he's talking about market activity. That's not what he's talking about. He's talking about weather. So he's like, well, we're not sure if the reason why we had a drop in pending activity is because the weather was cold. Now, you know what the fascinating thing is? I'm hearing this from people in Austin. I'm hearing this from people in Miami. I'm hearing this from people in Arizona. I'm hearing this from people in Connecticut and Minnesota. So I don't know. I don't think so. When you look at every submarket, everyone is saying the same thing. And I would say this is what we're hoping for, right? As an industry, we're saying, well, I think it's because of the weather. But when every single market experienced exactly the same thing, it's like, who in Mesa, Arizona said, I'm not going to go shop for a house because it's 45 degrees? Right? Who in Austin, Texas said, oh, I'm going to pause my entire month-long home search because we had one day at 20 degrees where in the afternoon it was already back up to 40? I think this is like hopeful thinking, but I don't think this is rooted in any sense of reality whatsoever. When we look at the data, 47 was the reading for the month of December. And not only was that the lowest pending home sales index for December, but it was the lowest one ever recorded in the history of them tracking this data, going all the way back to January of 2001 when they started tracking the data. It's the lowest one ever. The preliminary figure for January 2025, it's not going to be final until the end of the month, it's 57. And that's the lowest one for any January. And when you look at it plotted as a graph, you can see the dotted line is the average going all the way back to January of 2001. And we now have 1, 2, 3, 4, 5. We are in the 5th month where we are experiencing a year-over-year decline on the pending home sales. Now, there are a lot of reasons why, and of course, we know the reasons. We've got affordability challenges. We've got high prices. We've got up until 2023, 2022, we've got low inventory. We've got high interest rates. We've got all of those reasons. But when you notice a trend, and then every year you notice an excuse for why it's lower. Oh, it's the weather. Oh, it's this. Oh, it's the election. Oh, it's the this. Let's just agree that we're just in a real estate cycle that repeats itself over generations. And you can see that for December, we were down month over month 20%. But let's take a look at the year over year. We were down 3.1% year over year. And we've been in this season, year over year, going all the way back to 2021, where it's been correcting. Now, across the entire nation, we experienced a year over year increase. September, October, November. We saw the same thing happening within Austin, where September, October, November, they were really good months. Prices went up, demand went up, activity went up. And then we just hit a pause. We can see that on the new listing to pending ratio. We can see that within the activity index. Everything is pointing to just like a really big contraction within the demand for real estate. And you can see this for January at 57. So we 9.2% drop 2022, 22.4, 6.8, 5.2. These are year over year. Now, let's take a look at our specific market and let's see the number of sold properties within our specific market. So we know that pendings are down. Pendings were down 14.7%. Well, let's take a look at sales. And I had to run this a few times because when the data cranked out, I couldn't believe it. 1,683 sold properties for the month of February. 1,683. February 2024, 2,364. That year over year is a drop of 28.8%. This is where I'm going to repeat just how unbelievably proud I am of us as a team of you all, because we're up like 25%. So I just cannot be more just proud of the team, of our ability to understand the market, know what's going on with the market, and then say, well, we've got the macro market that I have to be aware of. It's my job to know the macro market. But then I've got my personal market. I've got my interaction with my clients. I've got my personal work ethic. I've got my personal goals and desires. So way to go. Way to go, team. I mean, really fantastic. I absolutely love this. I care about the market in the sense where it's my job to understand it. I love this stuff. I love data, but I don't care about the market in the sense of what it's going to make me do every day. Every day I'm going to wake up and I'm going to do my job to the absolute best of my ability. I see you all doing that. So unbelievably proud of us as a team and each of you individually. But we can see right there the 28.8% year over year decrease on the number of sold properties. That is going to be the second highest drop for the month of February. The only number that is higher than this is going to be February of 2009, where we had a 30.1%. When I add, well, let's take a look at the graph. And here's the graph, number of sold properties. And we can see that we had a really good run up from 2012 all the way to 2020 for an 8-year period. It was always year over year positive, 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 positive. And then, of course, we have 2021 that went down, picked back up 2022, down again 2023, picked back up 2024. And then we see the second biggest drop on record. The only drop that was bigger was between 2008 and 2009 by a fraction, not even a huge difference, by an absolute fraction. Let's take a look at all sold properties, cumulative, January plus February. For our market, we are down 15.9%, 3,531 properties sold for January and February. This number is going to go up a little bit. Agents are still changing the status of the MLS. It's only March 3rd. And even though agents have 24 hours to change the status of the MLS, we all know that they don't. I expect about another 150 or so properties the status will change from either active under contract, pending, over to sold. That's what we see after the month changes over. We see agents going back, oh, I forgot about that, and they'll go ahead and change it to sold. So we can expect this number to increase by about 150, but that's still a massive difference. We're at 1,683, February 2024 at 2,346. Let's take a look at pricing. So pendings are down, sales are down for February, down by a lot, double digits. What do you think happened with price? Pendings are down, sales are down. What do you think happened with price for the month of February? Absolutely shot up, 7.1%. I mean, gosh. Isn't that crazy? Now, there's a reason why. We noticed a large amount of expensive homes sell in the month of February. There was an uptick. It was this imbalance of the market where a lot of homes early into the month, first 14 days of the month, and we're talking about like really expensive homes. There was a $12 million home, an $8 million home, a $5 million home. And that trend is happening across the entire nation. We do have money, resources coming out of the equity market. A lot of really wealthy people believe the equity market is overvalued, due for a correction. And they're also noticing, like, where do you park your money for long-term asset protection, long-term store of value? And they're seeing certain areas within Austin as a really good store of value for a large amount of financial wealth. That's happening across the country. We noticed that trend across a lot of different markets. Austin was certainly the beneficiary of one of these trends where money was pulled out of the equity market into the real estate market in the form of cash transactions. I would say we're going to have a little bit of a rollover of that into March, but it was primarily concentrated within February. I do not see that as sustainable for the rest of the year. I do believe that this is more of like a one-off as opposed to like this sustained buyer activity that's going to roll for the rest of the year. Now, we'll have some rollover into March, possibly some into April, but we're not going to see this trend across every single month this entire year. I expect both the average and the median price to just start backtracking from this demand in really nice, expensive luxury properties. Another reason why we notice a big demand within these luxury properties, the price drops that they experience from May all the way through December. So we noticed that property that was on the market for $15 million is now on the market for $11.5. Bam, cash offer. That property that was on the market for $7.5 million down to $5 million. Bam, cash offer. So we do have a segment of the population that saw that as I feel like that's a good value, and I'm going to transfer money out of the equity market. I'm going to cash in my equity position and put this into a long-term store of value, store of wealth. That happened. So up 7.1% year over year, up 3.9% on the average sold price. On the median price, we're still down 2.2% year over year. We were up on the sold to list price ratio. So sellers commanded a little bit more compared to both December and January. Now, let's take a look at a few more things. Let's take a look at the Freddie Mac Home Price Index. This was published February 28th. This is where it tracks the top 40 markets when you look at population. Very accurate index. They've been publishing this going all the way back to 1970. It's extremely accurate. I really like it. So where does Austin fall within the top 40 cities population-wise? And then we're also going to look at all of the cities that they track, over 300, I believe, 360 plus cities they track. But let's take a look at the top 40 cities. Peak month, Austin, May 2022. From the peak, according to Freddie Mac, we are down 16.8%. When you look at our data, on the average, we're down 16.11%. On the median, we're down 21.82%. According to Freddie Mac, we're down 16.8%. From January 2020, so this is pre, the sickness, we're still up 38.5%. Even from January 2021, we're up 16.4%. Interesting thing is that when you look at the from 2020, we've got Austin up 38.5. Then we've got Minneapolis up 34. We've got Portland up 34. Sacramento 36. San Francisco 23. But a lot of cities, we got quite a few cities reaching record highs. If you see a blank here, Baltimore reached a record high. Jacksonville, record. Vegas, record. LA, record. Amazing. Nashville, record high. Orlando, record high. So they are experiencing the market that we experienced May 2022. Now, from January 2022, we're down 9.8%. We are one of two cities down. Only one of two. The only other city that's down since January 2022 is going to be San Francisco, down 0.9%. We're down 9.8%. Year over year, we are down 6.7%. We are one of two cities down. The only other city down year over year, San Antonio, down 0.5%. And then we've got month over month. Month over month, we're down 3.4. We've got San Antonio down 2.7, San Francisco down 0.6, and Tampa down 0.7. So when you look at the drop from the peak, we're number one, followed by San Francisco at 5.1, San Antonio at 4.9. When you look at from January 2020, we are 1, 2, 3, 4, 5, 6, 7, 8th. We're the 8th lowest city on appreciation from January 2020. Look at some of these cities. Look at Miami, 76%. By the way, this dotted line is the average of the top 40 cities. Crazy. From January 2021, we are second on the list. San Francisco has appreciated a little bit less than we have. The average is 35%. We're at 16.4. And look at Miami, 59.1. Just incredible. Now you look at from January 2020, only two cities down, Austin and San Francisco. Year over year, Austin and San Antonio. The average appreciation for the top 40 cities in the country year over year is 10.5% plus. We're down 6.7%. And only San Antonio is the other city that's down. Month over month, the top 40 cities across the nation, month over month, appreciated by 3.49%. Only four cities went down: Austin, San Antonio, Tampa, San Francisco. When you look at all of the cities, so forget the top 40 population-wise, every single city. Austin, we peaked May 2022, we're down 16.8, followed by Punta Gorda, Florida. July 2022, they're down by 11.6%. And these are the top cities with a price decrease. 276 cities are down from their peak. That's 71.9. This index tracks 384 cities. 108 cities, 39.13%, have reached record high pricing. 39.13%, record high pricing. And you can see the peak distribution. 28 cities peaked May 2022, Austin being one of them. We've got 86 cities peaked July 2024. 108 cities reached their peak January 2025. This data is published on a monthly basis. It'll be published again next month. So really interesting just to see how Austin compares to the rest of the country. We are absolutely leading what could very well be a national market correction that I personally believe will start happening 2025. Let's take a look at inventory. As of this morning, we have 12,227 active homes on the market. We are up 5.21% month over month. We're up 16.7% year over year. On the pending side of things, we've got 4,057 pending. We're down 7.1% year over year. That's going to give us an activity index of 24.9%, 4.32 months of inventory. We can see active listings, we're up 16.7% year over year. Pending listings, we are down 7.1% year over year. Activity index, lagging last year by 15.3%. Out of all of the active listings on the market, 12,297, exactly 46% of those have actually experienced a price drop. 50.4% have remained the same, and 3.5% have actually experienced a price increase. Now, the other thing that I want to go over really quick, and let's take a look at the distribution of inventory. New construction continues to just lead the pack when it comes to activity. We've got a 30.15% activity index. That's going to be the pending divided by the active plus the pending on new construction, 30.15%. Resale, 22.14%. So we still have demand, which is a good thing, but we're right at that 4,000 pending mark. So inventory keeps on going up. We are noticing an increase in inventory. We're noticing an increase on this category, special listing condition. We've got 9 notice of default, 44 short sale, 10 pre-foreclosure, 6 in foreclosure, 6 auction, 1 bankruptcy, 75 real estate owned, 8 third-party approval, 10 HUD owned, 200 estate, and 28 under probate. This number is going to go up, and this number is going to go up for a few reasons. So let me give you some historical information. Back in 2007, 35% of FHA borrowers had a debt-to-income ratio above 43%. So 35%. So someone over chat, write down 35%. 35% of FHA borrowers had a debt-to-income ratio above 43%. 35%. So a volunteer, write down that over chat. Okay, good. Thank you, Melanie. What do you think that number was by 2020? I'll give you that number, 54%. 54% with the DTI above 43%. So less qualified buyers that are taking a higher debt load. And that number is even higher for 2024, even higher. I believe that number is closer to 60% for 2024. And we're noticing some DTI ratios well north of 50%. North of 50%. So buyers are carrying more debt load. Now, here's a few other numbers for you to keep in mind. As a percentage, let me give you some historical. So during the previous housing correction, the delinquency rate for FHA mortgages was 7.02%. So write that number down. During the previous housing correction, the previous housing bubble, the delinquency rate for FHA mortgages, 7.02%. And that's going to be the delinquency 90 days or more past due. Okay? And have been originated within a 12-month period. So the loan is within 12 months. They just got the loan. They just bought a house a year ago, less than a year ago. So within a 12 months of origination, they're already 90 days or more past due. It was 7.02%. Guess what it is right now? For 2024, basically right now, 7.05%. In 2024, 7.05% of FHA mortgages became seriously delinquent, 90 days or more past due, that have been originated within a 12-month period. I mean, just let that sink in. The last time it was 7.02, so we're already higher than last time. So why aren't you seeing these numbers go up? Like, why aren't you seeing more notice of default? Why aren't you seeing more pre-foreclosure, foreclosure? Why is that? Why is that? I want you to write down another number. I'm going to give you the number of FHA loans that went seriously delinquent last year. You ready for this? 52,531. 52,531 FHA loans went seriously delinquent last year. What is seriously delinquent? 90 days past due on loans originated that within a 12-month period. How many were foreclosed on? This is where you get to guess. I need 5 guesses. 52,531 FHA loans went seriously delinquent last year. How many were foreclosed on? Melanie, 9. Bertina, 10,000. We got 2 guesses down. We need 3 more guesses. Okay, we've got Sonia, 15%. 15% gives us about 7,600. Keep on going. 2 more guesses. Okay, Harold, 500. 1 more guess. Charmine, 0. Iden, 50%. The person that got the closest was Charmine. The number is 9. Not 90, not 900, not 9,000. 9. 9. What are the chances of someone ever catching up when they're already delinquent for 90 days? The chances are 0. What's happening is FHA instituted a program that will pay the mortgage servicers to cover the missed payment for the borrowers. And they did that a few different ways. One of them is that the missed payment was simply added to the loan principal with 0 interest. Like, okay, you know what? You missed your payment for 6 months. It's $2,000 a month. We're going to take $12,000. We're going to add it to the back of your loan. And that's going to be that silent second. Once ever you sell your property, then you pay that money back to us as a silent second. That's not even recorded in public records, by the way. Not even recorded in public records. And you'll pay us back interest-free. Just kind of don't worry about it. That's one way. Another way is where FHA mandated that servicers were paid to reduce the monthly payment by 25% for a 3-year period. And then the reduction was added to the principal, also without interest. So bottom line is that only 9 were foreclosed on. Only 9. So there was a financial incentive to the service providers not to issue a notice of default, not to foreclose on. Now, to put this in perspective, when you look at, let's just take a look at December. 15% of mortgaged homes used FHA loans in the month of December, right? That's down a little bit. So we have a lot of mortgages out there. The number of properties that are currently in default exceeds the number of FHA loans that were issued Q4 of last year. Right? And these are the incentives that FHA made to service providers to, in essence, make it impossible to foreclose on. 55,641. So the big question is that number one, is that right? Number 2, is that sustainable? Number 3, is that program going to keep on going? And I would say no, right? It's not sustainable. I think it was right for a period of time, especially during COVID, but man, that was like 5 years ago. So at one point it's like, it's like, what's going to happen? Now, there was a What was happening is because the market kept on going up and up and up, people were able to sell their house. They were able to cash in on that equity. But now that the market has stabilized, and now that in some markets, the market's already peaked and gone down, that equity is basically gone. That is why we're seeing these numbers go up. That's why now we're seeing short sales go up and all that. So imagine if or when the 55,641, the incentive not to issue a notice of default, a foreclosure, a pre-foreclosure. Imagine when that's like, hey, you know what? Like, it's over. Like, there is no more money. There is no more incentive. Like, there's nothing that we can do at this point. We ought to see a flood of properties hitting the market that fall under that distressed sale category. And I go back to that first number that I shared with you. The fact that 7.02% was the delinquency rate at the peak of the previous housing bubble. And it's at 7.05% right now. And these are loans that had very little down payment, 3.5% down. So the market doesn't have to correct 20% for the equity to be evaporated. As a matter of fact, the market has to gain 8% appreciation for them to break even. And that's not happening. So that's where all of this ties in with my prediction that we're going to have a continued pressure on pricing. And that I do believe that 2025 is the year where we will experience a pretty significant amount of pressure in pricing. When you add that to the number of active listings that we are seeing January and February, there's no way that we won't see added pressure to pricing. So keep that in mind as you are helping buyers, as you are certainly listing properties for sale. Real estate, of course, is hyper local. We went over big macro level national stats, national pending, and then we, of course, drilled it down to the local Austin area. But it's definitely something that you need to be very much in tune with. Now, let's take a look at the bond market here really quick. If you take a look at my screen, let's go ahead and take a look at this really quick. Let me turn around and see what's going on. We're actually down 2.2 basis points within the bond market. We were up earlier today. You can see that line went up a little bit. Let me see that line started way up here and then it kind of went down. Well, the reason why it went down is because the Institute of Supply Chain Management issued their pricing index and it went way, way above expectation. That, of course, is inflationary, and we just saw a huge pullback within the bond market. My clients ask this, if there are going to be any tax implications to owning two homes during the overlap period. What do you mean by that? Tax implications to owning two homes within the overlap period. Well, you can only claim a homestead, like you're talking about like a homestead, you can only claim homestead at any given moment, but they're going to keep the homestead within that entire year for the property that they're buying. But are they over 65? Do they have any sort of disability? We might want to take this offline actually, because keep in mind that this is public. Like this Monday touch point is published like for the world to listen to. Oh, can't hear you, Sonia. Oh, go for it. Yes. Okay. But what like, they're talking about property taxes? They talking about like capital gain taxes? Like what when you say tax implication, like what do you mean by that? Yeah, if they've lived in the property for 2 out of the past 5 years and they're still obviously within that 2-year period, then that's really not a big deal. Yeah, as long as they lived in the property for 2 out of the past 5 years, I mean, they could convert that into a rental, they can convert that into whatever they want, and that would still be fine. Now, on the homestead exemption side of things, they can only claim homestead exemption on one property at any one given time. So that's going to be something that, of course, they're going to have to look into. But then I also don't know if they have an over 65 exemption, if they have a disability exemption, because those can be transferred mid year. Yeah, of course. Absolutely. Absolutely. So let me take a look. One last thing that I want to report to you all. Mr. Robert Merrill, the amazing Robert Merrill, sent me his rate sheet earlier today. Let me take a look at what rates are. So held the Friday pricing. So we are looking at 6.625. FHA still right at exactly 6% on FHA. So no movement within the mortgage market, within the conventional 30-year when you look at Robert's rate sheet. And once again, so far today, we started on the negative on the 10-year T-bill. That very closely correlates to 30-year mortgage rates. And then thankfully it went down, but it went down because of not so positive economic news. But you know the drill. When you've got really positive economic news, that actually affects negative on rates. If you have really bad economic news, that affects positive on rates. So we did have some less than desirable economic news happen this morning. Primarily the Institute of Supply Chain Management issuing their pricing index that came in way hotter than expected. That is inflationary. And of course, that helped out rates. Well, y'all, it is 11:03. Any other questions, comments, concerns, criticisms, or complaints? Any other questions, comments, concerns, criticisms, or complaints? I want to remind you all that we have our Wednesday broker Q&A contract review, and we do not have a meeting this Friday. No meeting Friday, no team meeting Friday. The reason why is that the kiddo has regionals that she's playing, and hopefully they will do very well. And then that means that she would go to nationals in Boston April 1st through April 6th. But so far, we're just one step at a time, right? So she's got a game a Thursday, but we're just going to go back same day, but we don't have a meeting on Friday. Any more questions, comments, concerns, criticisms, or complaints? Going once, going twice. All right, you all, thank you all so very much for joining. Super appreciate it. Be on the lookout for an email summary from me with all of this information. Thank you so much, Melanie Price, for the amazing feedback on the chart, and I'll make those changes right away. By 11:09, all of those changes will be made. Thank you all so very much for joining. Super appreciate it. Have an absolutely amazing, excellent rest of your day, and we shall be in touch.